Welcome back to Retire Wealthy, your absolute favorite spot for retirement lifestyle tips and financial wisdom. Today, my dear retiree friends, we're about to tackle everyone's least favorite season of the year. That's right, tax season. But don't worry, I'm not here to spoil anyone's day. In fact, I'm here to brighten it significantly because we're going to discuss how you can legally and comfortably pay less taxes during retirement. Let's dive into these golden nuggets of wisdom and keep more golden coins safely tucked away in your pocket. Now, as retirees, most of us live on fixed incomes. Maybe you've got some Social Security, perhaps some pension checks, retirement account withdrawals, and maybe even rental property income or dividends. What you don't want is Uncle Sam grabbing more of those precious dollars than necessary. It's your retirement. You've earned it. And now, let's make sure you keep as much of it as humanly possible. Ready to legally outsmart the IRS? Let's get started. Tip number 1, choose tax-friendly retirement states. When you retire, the state you live in dramatically impacts your tax bill. Did you know some states don't tax retirement income at all? That's right, no pension tax, no IRA tax, not even Social Security. Some states like Florida, Texas, Nevada, Wyoming, Alaska, and Tennessee are known tax-friendly retirement havens. Moving states may feel drastic, but even if you love your current state, keep in mind that slight adjustments across state borders could significantly reduce your yearly tax payments. Remember, every penny counts when you're building your retirement comfort nest. Why not choose a state that lets you keep that extra money to enhance your lifestyle instead of handing it over to the taxman? Plus, sunny states mean you can trade snow days for beach towels. I mean, who's going to complain about that? Tip number 2, maximize your Social Security benefits wisely. Next up, let's talk Social Security strategy. A carefully timed claim of your Social Security benefits can greatly reduce your taxes. When and how you take out your Social Security makes all the difference. Did you realize that, depending upon other sources of income you have, up to 85% of your Social Security could become taxable? Yikes. To avoid this sting, try to structure your withdrawals from IRAs, Roth accounts, or pensions to control your annual taxable income. For example, withdrawing more from a Roth IRA, which is already tax-free if conditions are met, and less from traditional IRAs in certain years can reduce your taxable income and thus reduce taxes on your Social Security. It's all about understanding how taxable thresholds work and then strategically timing your withdrawals. Bottom line, planning your Social Security carefully saves money. Tip number 3, consider Roth IRA conversions. Here's a big shiny tip to lower your tax bill in retirement. Consider Roth IRA conversions strategically before or during retirement. Converting retirement savings from traditional IRAs or 401ks into Roth IRAs means paying taxes today, ideally when your income is lower, to enjoy tax-free withdrawals later. Yes, you'll bite the tax bullet today, but just once. After your conversion, all your future gains and withdrawals from that Roth IRA are completely tax-free. Even better, Roth IRAs don't have required minimum distributions, RMDs. No RMD means no forced withdrawals that push you into higher tax brackets later in retirement. Isn't that worth considering? Tip number 4, keep an eye on required minimum distributions, RMDs. Speaking of those pesky RMDs, don't ignore them. Once you hit 73 under recent law, if born between 1951 to 1959, starting year is 73, and after 1960, it's 75. You're legally obligated to withdraw a minimum percentage each year from your traditional retirement accounts, whether you need the money or not. Why is this so important? If you miss an RMD, even by accident, Uncle Sam slaps you hard with a 25% penalty on any shortfall of the RMD amount. Ouch. Make sure you calculate RMDs correctly and consider increasing distributions in years where your taxable income is lower to stay in lower tax brackets in future years. Better yet, consider making qualified charitable distributions, QCDs, directly to charity from your IRA. Doing so fulfills your RMD requirement and helps you avoid including these amounts into your taxable income. Bonus points. You help out your favorite charity while shaving off tax dollars. It's a warm, fuzzy win-win. Tip number 5, utilize the standard deduction or itemize strategically. When you're retired, it's crucially important to understand deductions. Many retirees take advantage of the generous new standard deduction rates introduced in recent years. However, certain expenses might be tax deductible. Medical costs, property taxes, charitable donations, mortgage interest, even state and local sales taxes can still add up and save big. For retirees, medical costs frequently pass IRS deduction thresholds, so keep organized records and explore itemizing carefully. The key tip here is plan the timing of significant expenses, ideally in one tax year, which can push you above deduction thresholds. Letting you itemize at a greater benefit than in another year, simply take the larger standard deduction. This timing cliff trick can translate into substantial savings.
Tip number 6. Use tax-advantaged investment strategies.
Here's one especially for those of you retired folks holding investments or portfolios. Make sure you're tapping into the benefits of tax-efficient retirement investing. Focusing on long-term capital gains rather than short-term gains, for instance, can significantly reduce your tax burden. Long-term capital gains for most taxpayers are taxed at much lower rates than short-term gains, sometimes even at 0%. Also, consider tax-free municipal bond investments, particularly exciting for retirees living on fixed incomes. They offer dependable interest income entirely tax-free at the federal level, free from state taxes too in some areas. Why would anyone pass on completely tax-free investment income? It's the financial equivalent of free ice cream on a warm day. Irresistible. Tip number 7. Downsize your home or use reverse mortgages strategically. Here's an unconventional trick. Consider downsizing your home to unlock tax-free gains. If you've lived in your primary residence 2 of the last 5 years, you could potentially shelter $250,000 of capital gains, $500,000 if married filing jointly, from taxes entirely. At retirement, many people no longer need the big family home. Why not simplify your life, reduce maintenance and property taxes, and unlock tax-free money all at once? And while reverse mortgages remain controversial, they are another way to access your home's equity without generating taxable income. Explore carefully, but use thoughtfully. This option can boost your retirement income without increasing Uncle Sam's share. Tip number 8. Pass on wealth effectively. Leave a tax-efficient legacy. Paying less tax in retirement includes smart strategies to pass wealth efficiently to heirs. If leaving a legacy is important, reducing estate taxes and capital gains taxes through gifting strategies or trusts can create substantial tax benefits. Even more, recipients typically benefit from stepped-up cost basis after inheritance, reducing or completely avoiding capital gain taxes if they sell inherited assets promptly. Seek professional estate planning advice to structure your legacy wisely and make sure your loved ones, not the IRS, enjoy your hard-earned savings.
Conclusion: small tweaks, big savings. There you have it, my retiree superheroes. A complete, actionable roadmap to legally reduce taxes in your golden years and increase the quality of your retirement lifestyle. Each of these tips, no matter which ones suit your life, holds immense potential to keep more money in your wallet and less in the IRS coffers. Remember, paying less tax legally isn't about sneaking around the rules. It's about understanding the rules, using them responsibly and wisely, and maximizing your well-deserved retirement wealth. Thank you so much for joining us today. Remember to like, subscribe, and hit that bell icon to stay informed of our upcoming wealth-boosting episodes right here at Retire Wealthy. Until next time, enjoy your retirement, live life fully, and keep more of your money where it belongs, with you.